Hello, I'm Nathan with Investing Ideas. A lot of people I know want to start investing, they just don't understand the ins and the outs, or there's some people who don't know whether they should invest or not. Welcome to my Basic Investing 101, where I discuss with you the basics of investing. First question I have for you, rhetorical of course, is how much money do you make? A lot of people will look at their paychecks, they'll think about their monthly income. What they don't think about is the reality. The sorry reality is that people do not make as much as they think they make. The reality is you only make what you save. See, we're all holding companies, basic, simple holding companies, each of us. We hold money for other people, say Verizon, AT&T, cell phone companies, the gas companies, the electric companies, the grocery stores, Amazon, whatever have you, your expenses. Money flows through you. You temporarily hold money before you give it to someone else, or your debts. The reality is your monthly income is probably close to your expenses. You're not saving much. So what we have to do is pay yourself first. There's two ways to go about paying yourself first. First and most important is trying to cut your expenses, but I'm not here today to talk to you about budgets. The best way that I learned how to save money was through direct deposits. I was really horrible with saving money. So what I had to do was to create a direct deposit, would kind of separate myself from my money. The problem was it was being saved in a bank where the interest rates were low and I wasn't getting any much. First mentality is basically where you save money month to month and it eventually grows. I started with simply $50 a month going into a mutual fund. You want to save your money. Well, your money is worth less today than it was yesterday, due to two factors. You probably heard of inflation, but I want to introduce you to something dilution. Now some will argue that one leads to the other, but I'm not here to argue that. I'm just simply saying that dilution and inflation are out there making your money worth less today than it was yesterday. First, let's look at inflation. This is a chart going back to 2007 up to 2016. It's a month-by-month inflation chart. Now the numbers vary from negatives all the way up to 5-6%. That's 16 years. The average is going to be about 3%. 3% inflation. So that's going to be the target number for the rest of our discussion. We want to earn 3%. The other side of that, interest rates versus inflation. As you can see, back in the roaring 80s when we had a bunch of Reaganites running around, we were fighting the Cold War, interest rates were on the rise, the economies were going fast, and they were increasing interest rates because government money was flooding in to help fund the Cold War. Ever since then, interest rates have been declining to current interest rates, which are near zero. To start creeping back up, but to no real surmountable amount. And then finally, let's move on to dilution. If you notice on this chart, dilution, if you go back to about 2007, it's about $7,000. Now imagine 7,000 represents the total amount of money in circulation. So now it's obviously way more than that. We're talking about trillions and trillions of dollars. But let's just say that in 2017 there was $7,000 in existence, and everyone in America shared those $7,000. Everyone in the world, I should say, shared those $7,000. Now fast forward to 2016, even 17, and there's currently $12,754.80 in circulation. That means that between 2007 and roughly 2017, there was almost $5,275 added into the system. Where did that money come from? Quite simply, it's called things like quantitative easing. Quantitative easing, if you don't know, is where the Federal Reserve basically prints money. They print money out of nowhere, and they use that to buy up government bonds. These government bonds, basically, they buy them from the bank. The bank saves up people cashing government bonds. The bank pays them cash. And then in return, on occasion, what will happen is the Federal Reserve will buy up government bonds. They'll buy them up. And then that money that they're using to buy it up, the money they basically printed, goes into the banking system, which then gets turned into loans, ideally, to go out to small businesses, big businesses. That's what they call, when they hear, I don't know if you've heard it on CNBC, they talk about cheap, easy money. It's where interest rates are low and people can borrow money with variably no cost to them, i.e. low interest rates. And we've been in that low interest rates basically since the stock market crash, or the financial crash of 2008, 2009, when the housing industries fell. You'll see that surge right here. And the fact is, over time, this trend line, as always, will go up, making your money worth less today than it was yesterday. So the only way to move forward from here is a discussion about making your money work for you. Unless you want to work for the rest of your life to make money, you're going to have to become this guy up here and make your money work for you. And one of the first things we have to do is decide what kind of investor you are. Things you have to consider is your involvement. What involvement level do you want to have in your investing? You have to consider your time till retirement. How old are you? How much time do you have on this earth to let your money mature? You have to look at your risk profile. Me, I'm an aggressive person. I have a lot of risk. Some people don't want to risk the money. The money they have is the money they need. So the money that they're saving is important to them, and they don't want to risk it all. You have to look at your goals. Your goals to retire and just have some income to help cushion the bills, or is your goal to retire and take lots of trips and hopefully live an awesome life? Your experience level. We have to look at your experience level as far as have you never invested before? Are you watching this because you don't know anything about investing? Or are you a long-term investor and you're just watching this because you want to get brushed up and you have great experience level? That matters. You gotta look at the amount of money you want to invest. Ideally, obviously, the more money you want to invest, the better. But if you're talking about smaller amounts, that changes the risk profile. And we have to look at current investments. Do you have a 401k going? Do you have a savings account? Do you have bonds? What kind of investments do you currently have? Moving on, we'll talk about the low maintenance versus the active versus the hands-off. Simply what I'm trying to state here is you don't have to have a certain investment profile. You can literally give your money to someone who is going to put that money into a customized profile. You're willing to profit share with them some of your gains so that you don't have to worry about it. That's okay. You can also be a low maintenance person where you want to just put it in a diversified investment portfolio and then check on it every now and then, maybe once a month, maybe even once a year, and just check in on it. Or you can be an active investor like myself, where you're always looking for new investment ideas and trying to get every little penny you can out of the money that you're putting to work. Secondly, how do I invest? Well, we'll be focusing a lot on stocks, mutual funds, ETFs, or electronically traded funds. But you can also go into bonds, certificates of deposit, money market, technically savings accounts or investments, and assets. I won't be talking too much about the latter ones. I will talk a little bit about them, but not much. Let's go on to certificates of deposit. Money markets and savings accounts. I lumped them all together because they all have the basic same pros and cons. Pros, they're safe, they're low risk, they're backed by the banking system, the FDIC. And they're easy to access your money. At any time you can go to the bank and withdraw money. Con, it's just a very low return. Interest rates. Money markets, when I did this lecture, were only around were less than 1%. Let's just say that they're less than 1%. Savings accounts, you'll be lucky to get 1%. A 5-year CD, at best you're looking at 2%. A 5-year bond, 1%. 10-year, not even 2%. And a 30-year bond, you're lucky if you can get close to 3%, which is what that magic number we're looking for. Now, with interest rates going up over the next several years, you may eventually get to see very solid 30% bond yields, but not yet. I do want to talk a little bit about CD laddering or CD ladders. CD ladders is where you basically create a rotation of money in a banking system by simply buying CDs and letting them mature. Now, this plan that I have in front of you is where you take $10,000 and you put $2,000 into a 1-year CD, $2,000 into a 2-year CD, $2,000 into a 3-year CD, $2,000 into a 4-year CD, and a 5-year CD. And then after the first year passes, you take that 1-year CD that you bought and simply use it and roll it into a 5-year CD. And then so forth and so on with the 2, the 3, and the 4 until after about 5 years you have a rotating 5-year CD that expires every year. And what you're going to be able to do in that is you're going to be able to have a long-term CD, which is going to get you the better interest rate, but you'll have access to that money every year. Now, what I'm trying to show you here at the top is after 10 years, that $10,000 will be $11,782.80. That's based on the APRs or APYs you see on the screen here. It's a safe investment. It's an interesting investment, but definitely not hitting that target 3%. Moving on to bonds, similar to the other ones, it's got low risk. It's great for maintaining wealth. If you have a lot of money, you can put it into bonds and you can try to target that 3% that we talked about and maintain the money. And it can provide a stream of income for retired individuals. So bonds has its place. The cons is it's poor return, it's low return, it's low yield, it's poor for growing your wealth. So if you're young, bonds are not the way you want to go. It's affected by interest rates for the last, basically ever since 2008, 2009, interest rates have been on the decline, as we said, near zero. So it can be extremely affected by interest rates. Your money is locked up for long periods of time. If you want to get the good yields, like the 30-year bond, which gets us almost 3%, that's 30 years you're not going to have access to that money. Just another chart here just showing how bonds rate have changed over the decades. Now, we do expect a little bit of recovery, but I don't think we'll ever see bond yield rates anywhere near the booming 80s. Next, we're going to talk about mutual funds and electronically traded funds, or ETFs. Now, if you want to go with the hands-off or approach to investing, you want to put money into a mutual fund or an ETF. My discussion today is with you as a private investor. You may want to look at the ETFs closer, and the mutual funds closer for that matter. I circled on these slides the gross expense ratio and the net expense ratio. You look at them and you can see there's a major difference in the expense ratio. Now, expense ratio is essentially the amount of money or the percentage of money that these companies are going to take off the top to help cover their expenses. That's right. So every year, or whenever the pay period is, every quarter, they're going to take, for Janus is going to take 0.92% for their gross expense ratios right off the top. Whereas the Spider ETF is only going to take 0.11%. Now, how does that work? It's quite simple. It's a difference. Most mutual funds don't carry huge balances. For example, the net assets in Janus fund is $7 billion, whereas the total assets in the Spider SPY is $184 billion. So they're still making quite a bit of money. With the access of ETFs, it allows them to bring in more assets, which means they can take less, which means it's cheaper for you. At the end of the day, you might like Janus, you might like Fidelity, or whatever mutual fund you're using, but I would ask you to look at your expense ratios. Anything over 1-2% range is going to be extreme, but know that when you invest in a mutual fund, there's probably an ETF out there that gets you that. Now the big difference is, just before we go too far down the road, is a mutual fund is going to be one person looking to do the best for you as an investor, as far as getting the best return they can. And the SPDR ETF is just a computer algorithm that ETF is just a computer algorithm that follows a set programming to maintain a certain balance of certain stocks. Here's the catch. Mutual funds' goal is to reach or beat, is to match what the S&P 500 does. So I would argue, since the SPDR SPY is essentially the S&P 500, it is the bar. It's the bar that the mutual funds are trying to meet. So why would you not just invest in the bar? Expense ratios and fees, and in fact, let's just look at how a company taking the expense ratios away from you affect your long-term investment. So what I did here was I did a simple compounding calculator. I have 3 different scenarios here. And what I'm looking at is you put in $5,500 into your Roth IRA, and you do that over 40 years. You do that 40 years and let your Roth IRA grow by adding $5,500 initially and $5,500 annually there forward. I said compound the interest 4 times. I said 4%. S&P 500 is going to make about 6 to 8% on a long grand scale. So I said, let's do half. Let's be conservative. Let's just say 4%. And then I sliced away from that 4% some of the fees and expense ratios from your standard mutual funds, and I gave it about 2.6%. So that's about how much you're going to make on a standard mutual fund, that average was. And then I took the SPY or the ETF expense ratios, and I added them, and I took away 0.2%. And the result, after 40 years, the mutual fund is going to take about $207,000 potential profit away from you in order to pay their fees, whereas the ETF is only going to take $28,400. Now I will say the mutual funds do business, and they are going to watch over your funds, so they deserve a slice of the pie. My question to you is, do they deserve that much slice of the pie? Here's just a slide. I brought this from Barclays' site. This is just some ideas of different fees that you can see on any sort of a mutual fund. This is just one I pulled from Barclays. Now all of them are different. If you want to pause this and read it, you can. But just always look for the hidden fees when you're investing in a mutual fund. Time that I think that your first $10,000 needs to go into an S&P 500 index fund. Today I chose to highlight the SPY, the SPDR S&P 500. Now I want to show you how diverse it is. If you look on the left side, there's a pie chart. And that pie chart is just basically showing you all the different sectors we have. We have anything from basic materials to real estate, consumer defense, healthcare, utilities, energy, industrial technology, all of it. And then you look on the right side, the top 10 holdings: Apple, Microsoft, Exxon, Johnson & Johnson, General Electric, Amazon, Facebook, Berkshire Hathaway, AT&T, JP. So basic, huge, gigantic, big name Fortune 500 companies. 3, which are very large companies, no one has any more than 2%. And even the lowest in top 10 is barely over 1%. So what we're saying is here, you're going to be invested in 500 different companies. You are basically investing in the standard that all mutual funds are trying to accomplish. Moving on, outside of ETFs, let's talk about stocks. A lot of people just don't understand what stocks are. Stocks, also known as equities, are just a piece of a company. Shares are 1 unit of the stock of that company. So 1 unit, 1 share is 1 piece of that company. And then people will talk about market cap, like there was a big hubbub about Apple's market cap. Now granted, these slides are old, over a year ago when I first made this training. At the time, Apple was $97.92. Now it's considerably a lot higher than that. But market cap is simply taking the total number of shares times the share price. So if you had a company that was $97.92, take it by the total number of total shares outstanding, you would get a market cap. So that's how much the entire company is technically worth. So how do you make money on stocks? There's 2 basic concepts. You have growth and you have dividend. Growth is where you simply buy the stock and the price goes up and you sell it at a higher price. And then you have dividends. Dividends are essentially a profit share, where you buy a company like Apple, it pays you every quarter a set amount of money in the form of a dividend. Now, if you take that dividend, divide it by how much money it makes, you get a yield. Yield percentage is basically the dividend divided by the cost per share. So if I take the dividend for Apple, which at the time was $2.28, and I divide that by the $97.92, I get about a 2% yield. Not quite the 3% we're targeting, but really close. Now, remember, on the top of that 2.3%, you also have the potential for growth. So you have 2 factors of compounding in the chance to make money off this stock. Why stocks? Well, quite simply, over time, stocks go up, historically speaking. Now, if you went the entire stock market, I could go back all the way to the 1930s and it will show you it's always an upward trend over the long term. Short term, we will have collapses. I'm not trying to hide that. Look, in 2008, 2009, the crash was crazy. However, I want to tell you, look at this. If you had invested in the peak of the market somewhere in 2008, and you just left your money in the S&P 500 or the Dow, you would have almost got a 12% increase since then. Now, if you had been savvy and able to invest more money on the way down, getting stocks cheaper, you would have been up way more than that. Here's the S&P 500, pretty much the exact same shape of the Dow. And then the NASDAQ, which is the tech savvy side, which has the same exact shape. And the shapes are becoming more and more unison because of ETFs and mutual fund, or ETFs specifically. Here, I want to discuss bull versus bear market. Bull market simply meaning that everybody wants to buy stocks, everybody's bullish or wants more and more stocks, so the stock market goes up. Bear market is where the sellers are winning and everyone's selling their stocks and stock prices are going down. Now, going back all the way to the 1930s, you'll see what I don't want you to focus on is the magnitude. Obviously, you can only have 100% loss. You can't have 1,000% loss, where you could have 1,000% gain. So it's not the up and down trends that I want you to focus on, it's the length. The bull markets simply last longer, where the bear markets are simply blips on the radar of small corrections. Now, those are small corrections that affect a lot of people for several months, and I'm not trying to make light of it. People get hurt in bear markets. That's why there's so much fear in the stock market. But it's fighting through the fear is where you make all the money. The problem with these bull markets is people are scared of them until here, and then it takes off, and then it collapses. You just got to be in the market and follow it and be if you want to be nimble or not. But if you're in the S&P 500, as we've seen in the previous slide, you're going to recover. That'll be the conclusion of this video. If you want to learn more about individual stocks, if you want to learn about how to pick stocks, if you're wanting to move on to a more active investor and you don't just want to invest in mutual funds and ETFs, then look for my next video on stock fundamentals.